Hi friends, welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to quickly revise our Module C of CCFE, that is the Certification Course in Foreign Exchange Examination. The module name is Regulatory Requirement under FEMA for resident and non-resident entities. So in the module B, we talked about individuals and now we are talking about entities. So let's quickly revise the entire module in just 60 minutes, right? I will explain each and every important points bullet point format so that you can easily revise it in the easiest way. So let's get started. First of all, let's quickly understand the basic rule around import in India. First of all, importing goods is allowed for most of the item, but there is something called negative list. These are restricted item, and for those you need a valid license before you can bring them in. Now, if you are opening a letter of credit with a bank, the bank will first check this license, right? They need the exchange control copy, and bank will also see if there are any special condition attached. Bank and importer also keep a copy of the license after using it. Why bank and importer keep a copy of the license? Because internal auditor or inspector might need to check it later. When you buy foreign currency for import, you can use it for the purpose you mentioned or for any other legal purpose allowed under the Indian law. So whenever you buy foreign currency for import, you can use it for the purpose that you mentioned or for any other legal purpose. Once the good arrive, you must prove that you have actually imported them. This could be through documents like a bill of entry, a postal appraisal form, or a custom assessment certificate. Payment to exporter can be made in a different way. Instead of sending money abroad, you can credit their non-resident account in India. But remember, even then, you must prove import evidence. And finally, you need to make the payment within 6 months of the shipment date. The only exception is if you have held back some amount for reason like performance guarantee. So in short, we can say import freely, follow the paperwork, keep the proof, and don't miss the payment timeline. Right? So I hope this is clear now. Now let's look at the second paragraph. So let's break down some important RBI guideline for import, payment and currency. First of all, if import payment get delayed, maybe due to dispute, money problem or any genuine reason, your bank can still help you settle them. This can include interest or other charges as long as the delay is under 3 years from the shipment date. So if import payment get delayed due to dispute or due to any reason, due to any genuine reason, your bank can still help you settle them. So what bank can do? This can include interest or other charges as long as the delay in under 3 years from the shipment date. Next is let's talk about the trade credit. You know what is trade credit? This is when you don't pay for import immediately, but you pay for import after some time. For example, if you are importing capital goods like machinery, you can take up to 3 years to pay. Or for other goods, the limit is 1 year or your operating cycle, whichever is shorter, right? So we are talking about the trade credit, right? So basically when you don't pay for import immediately, but you pay for import after some time, that is called trade credit. So for capital goods, like machinery, you can take up to 3 years to pay. For other goods, the limit is 1 year or your operating cycle, whichever is shorter. So what is trade credit? The time, this is when you don't pay for import immediately, but you pay for import after some time. But there is a special case of it, that is the importing books. You can take as much time as you need to make the payment, but if you delay payment or pay within Ujan's bill within 3 years or pay with Ujan's bill within 3 years, interest rate must follow RBI trade credit rule, right? So I hope it is clear. For trade credit where you don't pay immediately but you pay after certain time. So depending on what kinds of goods you are importing, capital goods you are importing, 3 years to pay. And for other goods, the limit is 1 year or your operating cycle, whichever is shorter. Bank also have the power to extend your payment timeline. Very, very important thing. What I'm talking about, that bank has the power that they can extend your payment timeline 6 months at a time for up to 3 years in total, right? But you need a valid reason like a dispute over quality, financial trouble or pending court case. So that is the point I'm talking about, that extension of the payment time, which means bank have the power to extend your payment time. At a time 6 months it can be extended or total up to 3 years it can be extended. But for that also valid reason is required, like a dispute over the quality, financial trouble or a pending court case. Now currency rule, that if you are an Indian resident returning from abroad except Nepal or Bhutan, you can bring Indian currency note up to 25,000. How much? Up to 25,000 Indian currency note you can bring. From Nepal or Bhutan, if you can bring any amount. but only in denomination of rupees 100 or less. Last, let's talk about the guarantee. Bank can issue guarantee for import payment or deferred term if RBI approve. They can also give undertaking or comfort letter to foreign supplier, bank or financial institutions as long as it matches the foreign trade policy. So bank guarantee we are talking about. Bank can issue guarantee for import payment on deferred term, right? So suppose some import payment is due, right? Bank can issue guarantee for those such kind of import payment. Now, but the condition is that RBI should approve it. Bank can also give undertaking or comfort letter to foreign supplier, bank or financial institution as long as it matches the foreign trade policy. So in short, we can say, delays are allowed within the limits. Credit timeline depends on the goods. Right, I told you, trade credit timeline depends on the goods. For capital good, it is 3 months, 3 year, and for other goods, the limit is 1 year. And first point I told you that yes, delayed are allowed within the limit if the RBI feel that the reasons are genuine, then they can allow it. And the third point I told you that book import have some special flexibility, and currency limit vary by country. I told you if you are Indian resident returning from abroad. So like Indian resident, you are returning from abroad, right? So in that case, you can bring Indian currency note up to 25,000 rupees. And then we talked about, bank can back you with guarantee. Yes. So about guarantee, I told you that bank can issue guarantee for import payment on deferred term if RBI approve it. So on import payment with deferred term, bank can issue guarantee, right, if RBI approve. So these are the points which we have made clear. Now let's talk about the next point, next paragraph. Friends, if you are looking for quick revision notes on the foreign exchange certification course examination, you can WhatsApp me on this particular number. I will provide you the course link in which I have provided unit-wise theory, unit-wise MCQs, capsule PDF, previous year questions. All these contents will help you to secure good marks in the examination. Right, now let's look at the next slide. Let's talk about some key RBI rule for import payment, guarantee and documentation. In the import payment, guarantee and documentation, so first of all, let's talk about the guarantee for large service import. If an Indian company is importing services from abroad and need a big guarantee of our 5 lakh US dollar, so bank can issue the guarantee on the behalf of the importer, but they must follow RBI specific condition, right? So that is called large service import guarantee. Next point is that import timelines. If you have sent money abroad for goods, those goods must arrive in India within 6 months. For capital goods, the time limit is longer, up to 3 years. And once this period ends, you have 15 days to submit proof that goods were actually imported. Right? Then we have all the outward payment for import must be reported by the bank in RBI online system, that is called IIBF. If your payment is delayed, say you are paying through Ujans bill or your payment is overdue, so interest is allowed up to 3 years after shipment, but only at the trade credit rate approved by the RBI. If you want to pay before the due date, that is called prepayment of Ujans bill, right? What is prepayment of Ujans bill? Suppose you want to pay before the due date, you can do that, but you must deduct interest for the unexpired period. So you can pay before the due date, that is called prepayment. You can do that, but you must deduct the interest for the unexpired period. So that is calculated at either the claimed rate or LIBOR rate or another benchmark, whichever apply, right? So basically what I am telling you that suppose you want to pay before the due date, that is called prepayment. You can do that. So friends, if we talk about the import timeline, suppose you have sent money abroad for goods. So those goods must arrive in India within 6 months. For capital good, I told you the time limit is longer, which is up to 3 years. And once the period ends, you have 15 days to submit proof that the goods were actually imported. And I told you that all the outward payment for import must be reported by the bank in the RBI online system, that is called IIBF. And suppose your payment got delayed, say you are paying through Ujans bill or your payment is overdue. So interest is allowed up to 3 years after shipment, but only at the trade credit rate approved by the RBI. So what I am telling you that suppose your payment get delayed, like if you are paying through Ujans bill or your payment is overdue. So yes, interest is allowed. Interest is allowed up to 3 years after shipment. Interest is allowed, but only at the trade credit rate approved by RBI. Now if you want to pay before the due date, that is allowed. That is called prepayment of Ujans bill. You can, but you must deduct interest for the unexpired period. That is calculated. So the interest is calculated either at the claimed rate or the LIBOR or another benchmark, whichever apply. Now for documentation, right? Import bill normally should come from the overseas supplier bank to your bank in India. So from where it should come? It should come from the overseas supplier bank to where it should come? It should come to your bank in India. right? Import bill we are talking about. Bank are not supposed to process payment if bill come directly to you, the importer. But there are some exception. So what we are talking about, we are talking about the documentation that import bill normally should come from the overseas supplier bank to your bank in India, right? So suppose there is an overseas supplier bank, let's say Citibank in USA, and there is a bank in India called SBI, right? So import bill is coming from overseas supplier bank to your bank in India. Bank are not supposed to process payment if bill come directly to you, the importer. No, if the bill come directly to the importer, bank will not process the payment. It should come to the bank only. But there are some exception in which bank can process the payment. What are the exception? First case is that if it is very small bill up to $3 lakh, bank can allow that. If it is bill for wholly on Indian subsidy of the foreign company, then bank can allow it. That bank can process the payment, right? And if it is bill for big exporter like as a status holder, EOU, SEZ unit, PSU and all limited company. And here is a special rule. What is the special rule? For rough diamond, precious and semi-precious stone, bank can allow payment up to $3 lakh even if bill come directly from the foreign supplier. The only condition is that you must show proof of import at the time of payment. Right? For rough diamond, for precious and semi-precious stone, bank can allow payment up to $3 lakh if the bill come directly from the foreign supplier to the importer. Condition is that you must show proof of import at the time of payment. So in short, what we have discussed just now, that you should follow the timeline. Right? What kind of timeline I told you? That for first guarantee for large service import, right? So big guarantee over $5 lakh, bank can issue it behalf of the importer. Second thing I told you about, route document properly. Yes, document should be routed properly. That import bill normally should come from the overseas supplier bank to your bank in India. That is a normal route, right? Prepayment, yes, you can do the prepayment. That is, you can, but you must deduct the interest rate for the unexpired period, right? And exceptions are there. 3 exceptions I told you, that yes, bank can allow process the payment. Condition is that bill up to $3 lakh, bill received by a wholly owned Indian subsidiary, and bill for a status holder export or exporter 100% EOU. Now let's talk about the import documentation and evidence of good receipt. So friends, let's talk about one of the most important part of the import, proving that goods you paid for has actually arrived in India, right? Suppose the payment you sent abroad is more than $1 lakh, right? Suppose the payment that you sent abroad is more than $1 lakh. So your bank must make sure that you submit proof, right? So the payment that you say that you are sending abroad, that is exceed $1 lakh, right? So your bank must make sure that you submit proof for that. What could be the proof for it? This proof could be the ECC, exchange control copy of the bill of entry for home consumption. The proof could be exchange control copy of the bill of entry for warehousing. The proof could be a custom assessment certificate or a postal appraisal form. That is for goods that come in by post. So what I am telling you, that import documentation and proof of good in simple word. So one of the most important part of the import, that proving that goods you paid for have actually arrived in India. Suppose the payment you sent abroad is more than $1 lakh. Your bank must make sure that you submit proof. The proof could be exchange control copy of the bill of entry. The proof could be exchange control copy of the bill of entry for warehousing. And this apply to the 100% export oriented unit. And a custom assessment certificate or postal appraisal form. This is for good that come in by post. So these are the proof that you have sent abroad the payment more than $1 lakh and goods have arrived in India. For DA basis, DA, document against acceptance, DA transaction, right? So the bank will only make the payment after they get evidence that goods have been imported. That is called documents against acceptance. There are two kinds of things, DA and DP, documents against payment, documents against acceptance. So DA is also called the usance bill. Bank will make payment only if they are sure that they will, basically they get evidence that the goods have been imported. Now there is also a simpler option for certain trusted organization, right? So there are simpler option for certain trusted organization. Instead of submitting the exchange control copy of the bill of entry, they can give a certificate from their CEO or auditor confirming that goods have arrived, right? So instead of submitting the exchange control copy of the bill of entry, they can give a certificate from their CEO or auditor confirming that the goods have arrived. But there are conditions. What are the conditions? That the payment value must be less than $1 million US, and the importer must be either a listed company in India with a net worth of at least 100 crore, a public sector undertaking or a government of India department, or an autonomous scientific academic institution like IIS, IIT, audited by the CAG of India. So what I am telling you, that there is a simpler option for certain trusted organization. Instead of submitting the exchange control copy of their bill of entry, this kind of organization can give a certificate from their CEO or auditor confirming that goods have arrived. But there are conditions. What are the conditions? Payment value must be less than how much? 1 million US dollar. That means 10 lakh US dollar. An importer must be either a listed company in India, or a public sector undertaking, or an autonomous scientific or academic institution. In that case only, right, submission of ECC is not required. Right, certificate from CEO is more than enough. So in short, we can say, just to summarize, that for high value import, bank want proper proof. I told you na, for high value import, right, which exceed 1 lakh US dollar, then bank requires proper proof, which could be the exchange control copy of the bill of entry or for warehousing or custom acceptance certificate. Then I told you that, but for well-established organization, there is a trusted shortcut through CEO or auditor certification. Right? These are the points. Now, friends, let's switch our focus to the next slide, where we are discussing some special RBI rule around import documentation, non-physical import, and unique trade agreement. First of all, for certain organization like big government or academic body, bank may ask the CEO or the auditor to confirm that their account are audited by the Comptroller and Auditor General or CAG. So for certain organization, right, bank asks the CEO. Next, not all import are physical good. Not all kinds of import are physical goods. Some are digital, like software, data, technical drawing, or design, receive our email or the internet. In these cases, bank don't get a shipping document. So they ask for a chartered accountant certificate confirming that importer actually received the product. Now friends, not all import are physical good. Some kinds of imports are digital, like software, data, technical drawing, or design, receive our email or the internet. In these cases, bank don't get a shipping document, so they ask for a chartered accountant certificate confirming that the importer actually received the product. Now one more point is that if the value of import is more than 1 lakh dollar and the importer does not submit proof within 3 months of payment, the bank will actively follow up for another 3 months, even sending registered letter as reminder. Every 6 months, bank also have to submit a BEF statement to the RBI. This lists all the high value import case where proof has not been submitted for over 6 months. So that is what I am telling you, that half yearly BEF statement. Every 6 months, bank have also to submit a BEF statement which lists all the high value import case where proof has not been submitted for over 6 months. This BEF statement is sent online within 15 days after June and December. So half yearly BEF statement, what it means? So I told you that if the value of import is more than 1 lakh dollar and the importer does not submit proof within 3 months of payment, bank will actively follow up for another 3 months, even sending registered letter as reminder. Every 6 months, bank also have to submit BEF statement to RBI. So this statement, they list all the high value import cases where proof have not been submitted for over 6 months. The report is sent online within 15 days after June and December. On the other hand, for small import of 1 lakh dollar or less, bank don't need to chase the importer as long as they are confident the transaction is genuine and the importer is trustworthy. Now some special gold import rule. So nominated bank can import gold on a consignment basis. So nominated bank, they can import gold on consignment basis. A star and premium trading house, that is called STH, PTH, can also import gold on document against payment basis as per their entitlement, and there are no end use restriction, right? So we are talking about some gold import rule, that nominated bank can import gold on a consignment basis. A star and premium trading house, in short we call them STH and PTH, they can also import gold on document against payment, which is called DNP basis. Finally, let's talk about the merchanting trade. That this is when goods are bought from one country and sold to another without entering India's domestic market. So from one country we are purchasing goods and we are selling the goods to another without entering India's domestic market. So to qualify as merchanting trade, the good must not enter India's domestic tariff area. The goods should remain in the same form, no processing or no change. And for Nepal and Bhutan, goods from third country can pass through India under custom transit declaration as per the treaty of transit, and in merchanting trade this count as traffic in transit. So in short, basically the rules which we have talked just now, it cover how to prove import. So how to prove import? I told you that not all import are physical goods, some are digital, right? And one for value of import larger than $1 lakh, so in that case bank will actively follow up for another 3 months, right? So for how to prove import, then how to handle the digital product, right? So I told you that in some golds nominated bank can import golds on consignment basis. STH, PTH can also import golds on document against payment basis. And lastly, we talked about merchanting trade, when goods are bought from one country and sold to another country without entering the India's domestic market. That is called merchanting trade, right? So the goods should remain in the same form. These are the conditions. Now friends, let's switch our focus to the external commercial borrowing. So basically ECB means when an Indian company borrow money from a foreign lender. So this can be through loan, bond, or other financial instrument. You can think of ECB like taking a loan, but instead of borrowing from an Indian bank, you are borrowing from someone overseas. That is called external commercial borrowing. Means when Indian company borrow money from a foreign lender, right? So why do company do this? Why do company engage in ECB? Basically they engage in mainly to access large amount of money in the foreign currency. This is especially helpful for big corporate who need fund for long-term project, right? So ECB we are talking about whenever an Indian company borrow money from a foreign lender. This is called external commercial borrowing. So loan, bond, financial instrument, these are the way through which ECB can be done. Means Indian company borrow money, either loan or the bonds or financial instrument, right? So company goes into ECB to access large amount of money in the foreign currency. So they have to access large amount of money in the foreign currency. That's why they go into external commercial borrowing. There are two types of ECB. One is called rupee denominated ECB, which means you borrow in rupee and repay in rupee. Another is called foreign currency dominated ECB. You borrow and repay in that foreign currency like dollar or euro. That's the difference. Rupee denominated means you borrow in rupee and repay in rupee. Foreign currency denominated means you borrow and repay in that foreign currency like dollar or euro. The RBI keeps an eye on this. They decide how much you can borrow, what you can use it for, other compliance rule they decide. ECB is usually taken for long-term needs and large sum, like building a new plant, improving expensive machinery. A big advantage is the cost. If the loan comes from a country where interest rates are lower, it can work out cheaper than borrowing in India, right? So that's why I told you that it is for long-term and large sum. Like suppose you want to build a new plant, or suppose you want to import expensive machinery. So what is the cost is the big advantage. Suppose loan come from a country where interest rates are lower, it can work out cheaper than borrowing in India. Now when foreign currency is needed, for example, suppose to buy capital good from abroad, you want to buy capital good from abroad. For that you need foreign currency. So ECB can be a perfect fit. There are two ways to raise ECB: automatic route, approval route. Automatic route means if you meet RBI rule, you don't need prior approval. That is called automatic route. Approval route means for certain sector or cases you must get permission from RBI or the government before borrowing, right? So there are two kinds of route: automatic and approval. Approval means for certain sector or cases you must get permission from RBI or the government before borrowing. So in short, we can say ECB is a way for Indian company to borrow big, often cheap, from overseas lender, but always under RBI watch. Some more points about ECB let's talk about. So ECB usually comes with a minimum maturity of 3 years. That means you can't just borrow and repay in a few months. They are meant for medium to long term funding. Second point is that it is not just the RBI that monitor ECB. The Department of Economic Affairs, or we call it DEA, in the Ministry of Finance, they work together with the RBI to make sure that all the rules are being followed. And third point, so basically what is the conclusion is that ECB are long-term borrowing, closely monitored by both RBI and the Ministry of Finance, and most of them are linked to the US dollar. Now let's talk about the export of goods and services, right? So basically the main authority in charge of the export trade is the Directorate General of the Foreign Trade, or we call it DGFT, under the Department of Commerce. So DGFT is under the Department of Commerce is the regulatory authority, right? So bank, they are also called authorized dealer or AD bank. They can give guarantee for their export client in overseas trade. So bank, they are also called authorized dealer or AD bank. They can give guarantee for their export client in overseas trade, but only if they follow RBI prescribed condition, right? So bank give guarantee for what? For their export client, right? So bank have some export client in overseas trade, so bank can give guarantee. So when it comes to contract and payment, when it comes to contract and When it comes to contract and payment, your export contract or invoice can be in any freely convertible currency like dollar, euro, yen, or even in Indian rupees. But here is the important part. The payment you receive must be in a freely convertible foreign currency, right? So when it comes to contract and payment, your export contract or invoice can be in any freely convertible currency, right? But the important part is that the payment you receive must be in the freely convertible foreign currency, right? Now about the free of cost export. Sometimes exporters send good abroad for promotion without charging money. In such case, bank can waive the requirement for filling the EDF. What is EDF? Export declaration form. But only they can waive up to 2% of your average annual export in the last 3 years, or rupees 5 lakh, whichever is lower. So what is free of cost export? So sometimes exporters send good abroad for promotion without charging money. In such case, bank can waive the requirement for filling the export declaration form, but only up to 2% of your average annual export in the last 3 years, or 5 lakh, whichever is lower. For a status holder exporter, big exporter recognized by the government, the limit is higher. That is rupees 10 lakh or 2% of the average annual realization in the last 3 licensing year, whichever is higher. Now, if you export without receiving any foreign exchange inflow at all, so you have exported but you have not received any foreign exchange inflow, so in that case you need a special EDF waiver from the RBI. For trade related purpose, the financial year is always counted from April to March. You know it very well. Now you might also hear the term something called OPGSP, that means online payment gateway service provider, which is used for collecting export payment online, right? So for collecting the export payment online, this OPGSP system is used. And here is the useful rule, that if you are setting up an office overseas, your bank can allow you to send money for initial expense up to 15% of your average annual turnover in the last 2 years. So suppose if you are setting up an office overseas, right, means outside India, so your bank can allow you to send money for initial expense, which can be up to 15% of your average annual turnover in the last 2 years, or 25% of your net worth, whichever is higher. So they will look at your net worth, they will also look at your average annual turnover. For average annual turnover they will take 15%, and for your net worth they will look at 25, they will take 25%, right? And whichever is higher, that much financing bank can provide you for setting up an office overseas. So in short, we can summarize is that the DGFT, I told you, Directorate General of Foreign Trade, they set the rule, right? Main authority is in charge of the DGFT. Then we talked about payment must be in the foreign currency. I told you that when it comes to contract and payment, right? So your export contract or invoice can be in any freely convertible currency. But about the free of cost export, bank can waive the requirement for filling the EDF, I told you. Then we talked about, there is a special waiver for promotional export, which we have just discussed now, right? A special waiver is given. And also there is a cap on how much you can send abroad for starting an overseas office. So what is the cap? 15% of your turnover or 25% of your net worth, whichever is higher. That is the cap. Now friends, let's look at the export of the goods and services, some more key points. So let's go over some more important RBI rule for exporting goods and services. So if you already have an office or branch abroad, you can send money for its regular running cost. Things like rent, salary, utilities. What is the limit? 10% of your average annual turnover in the last 2 years, and there are certain conditions that you must follow. So that is called recurring office expense abroad. So if you have an office or branch abroad, you can send money for its regular running cost. Now exporter with at least 3 years of good track record can take long-term export advance, right? Basically advance payment from buyer for up to 10 years if it is for fulfilling long-term supply contract. So those exporters who having 3 years of good track record, they can take long-term export file. You can see they can take long-term export advance. Basically advance from the buyer for up to 10 years. That is called long-term. Why? To fulfill long-term supply contract. Some goods take a long time to make, more than a year, like a specialized machinery. In such case, your bank can allow you to take advance payment if the export agreement clearly says so. Again, under the specific condition. So that is the point. Now if you are participating in a trade fair abroad, right? Suppose you are participating in a trade fair abroad, you can take goods there for display and sale without needing RBI prior approval. But if some goods remain unsold and you bring them back, you must submit the bill of entry within 1 month of re-import. So suppose you are participating in a trade fair abroad, you can take goods there for display and sale without needing RBI prior approval. But if some goods remain unsold and you bring them back, you must submit the bill of entry within 1 month of re-import. Remember this key point. Now, what if you send good abroad for testing and they get destroyed? In that case, you don't need a bill of entry. Your bank can accept a destruction certificate from the testing agency instead. Now, there is something called a special notified zone, that is a custom designated area for a specific type of trade activity. You know, there is something called DTA, or we call it domestic tariff area. It is simply the part of India where normal custom duty apply. It excludes places like a special economic zone. Lastly, if you are exporting machine or equipment on a lease or hire basis, you need prior RBI approval. So the agreement ensured that you collect lease rental or hire charges and plan to bring the goods back later. So in short, we can say that these rules cover overseas office expense, right? So they cover the overseas office expense. I told you the limit is 10% of your average annual turnover in the last 2 years, right? And basically long-term advances are also covered. So I told you exporter who are having at least 3 years of good track record, they can take long-term advance. Then also we talked about the slow to produce export. So what is the meaning of slow to produce export? You know, some goods take long time to make, like a specialized machinery. So your bank can allow you to take advance payment if the export agreement clearly says so. That is called slow to produce export. Trade fair we talked about, that if you are participating in a trade fair abroad, you can take goods for display and sale without needing RBI approval. Then we talk about destroyed goods, right? So suppose you send good abroad for testing and they get destroyed, then you need bill of entry, right? Then we talked about special custom zones. So there is something called special custom zone. This is the custom designated area for a specific type of trade activity. Then we talk about the domestic tariff area. So this is simply the part of India where normal custom duty apply. Now in the next slide we talk about the export process, project export and currency regulation. Let's break down some important point about export process. First of all comes the dispatch of export document. So if you are a status holder exporter or SHE, or you work in a SEZ unit, your bank called the AD bank can allow you to send export document directly to the foreign buyer. So if you are a status holder exporter, your bank can allow you to send export document directly to the foreign buyer, right? But there is a condition. What is the condition? That you must send the duplicate EDF copy to your bank within 21 days of the shipment so that they can track it. So basically what we are talking about, the dispatch of export document. So your bank can allow you to send documents to your foreign buyer, but you must send a duplicate copy, that is called EDF copy, to your bank within 21 days. Second is the direct dispatch by bank. Sometimes the bank itself can send you shipping document straight to the foreign customer or their agent. This is allowed. So that is called bank also do the direct dispatch. This is allowed if you have received full payment in advance or there is an irrevocable letter of credit that fully covers the shipment value, and your sales contract or LC clearly allow the direct dispatch. Third, there is something called export on extended credit. If you are selling goods but giving a very long time for payment, say more than a year, say more than usual, so you can't just decide on your own. You have to submit a proper proposal through your bank and the RBI regional office must approve it. So that is called export on extended credit. Suppose you are selling some product and you are allowing the timeline for payment more than the usual timeline. So in that case, you have to submit a proper proposal through your bank and the RBI regional office must approve it. Finally, we have something called project export. This simply means exporting engineering goods and services where payments are delayed, like turnkey project, big construction work abroad, or infrastructure building outside India. And finally, there is something called currency rules for traveler. Suppose you are Indian resident. So you can carry up to 25,000 rupees in Indian currency notes when traveling abroad, but not to Nepal and Bhutan. And yes, if you are a foreign visitor living India, you can also take up to 25,000 rupees in Indian notes, but only through an airport, with some restriction for traveler from Pakistan and Bangladesh. So in short, what we have talked about is that export document handling has a strict timeline and condition, right? 21 days. I told you that you have to submit the you can send to the document to the foreign country importer or buyer, but you have to submit the EDF form and duplicate form to your bank within 21 days. Second point we talked about is that project export involving big contract. I told you that like turnkey project, big construction project, right? So they are also included under it. Then we discussed, that currency limit apply $25,000, 25,000 rupees. Remember, if you are Indian resident, you can take 25,000 rupees in Indian currency note, right? If you are foreign visitor, you can also take 25,000 rupees in Indian note. This is the limit. Please remember it. Now in the next slide, we talk about the export documentation. Friend, if you really think that this video is helping you to understand your concept, please hit that like button. This will encourage me to make more such and such content. Now friends, let's talk about some very important rule for export documentation and reporting. Basically, what exporter and bank have to do to keep RBI happy and avoid trouble. First of all, whenever export documents are sent to the buyer bank, whether for immediate payment or for collection letter, your bank, called the AD bank, must report the detail to RBI through something called the EDPMS system. So your bank, which is the exporting bank, right? Suppose they want, whenever export document are sent, they send the export document to your buyer bank. So what your bank will do? Your bank will send a report through RBI to the RBI through the EDPMS system. Think of it like a RBI master record for all import. Second, if you are sending goods by post, so you can't just pack and send them like normal parcel. You need a special form that is called EDF form. We have been discussing about this EDF form since the beginning, right? So you have to fill this form, EDF form, and it has to be countersigned by your bank before the goods are shipped. Third, sometimes exporters submit document late after 21 days of shipment. The good news is that your bank can still process them without RBI special permission as long as they are happy with your reason for the delay. Fourth point is that there is something called late submission of export document. I told you, duplicate EDF form and shipping paper. So you are once you give the bank your shipping paper or EDF form for payment, you normally can't give them back unless you need to make correction and resubmit. So once you give the bank your shipping paper or once you give the bank your EDF form for payment, you normally can't get those shipping paper and EDF form back unless you need to make correction and resubmit. Next point is that for landlocked country, sometimes the bank can give one negotiable bill of lading to the ship captain or trade representative. Right? For landlocked country, the bank can give one negotiable bill of lading to the ship captain or trade representative, but only if it is under an irrevocable letter of credit and all the LC conditions are met. Right? So this is a very important part. Then, so sixth point is that exporter can pay commission to agent abroad. Right? Exporter can pay commission to an agent abroad either by sending money directly or by deducting it from the invoice, but you must apply to your bank for approval. Right? So that is called sending commission. Basically what I'm talking about, that exporter can pay commission to the agent abroad either by sending money or by deducting it from the invoice. Suppose if you have to re-import goods, right? Suppose you have to re-import your goods because they were defective or of poor quality. The same bank that received the payment can allow a refund to the buyer, right? Now, and finally, exporter must always mention their IEC code. You know what is IEC code? Importer Exporter Code from DGFT. The DGFT issue this code. So exporter must always mention this IEC code on all the declaration form and communication with the bank or RBI. That is your export ID card. So in short, you should keep your bank informed, right? So basically, your export document you can send to the buyer bank, but you must report the detail to the RBI. Bank must report the detail to the RBI through EDPMS system. Second point I told you, if you are sending via post, then bank must countersign it, and then EDF form has to be filled, and then you can parcel it. And then after I told you that if the exporter submit the document late, right, like after 21 days from shipment, in that case it is extendable, but you have to provide the proper reasoning. Then I told you that basically follow the RBI rules. Landlocked country, bank can give a negotiable bill of lading, right? Then we talked about exporter can give commission to the agent abroad, and if you want to re-import the goods, yes, the same bank can receive an IEC code we have talked about. In the next slide, let's talk about export declaration and realization timeline. Whenever an exporter sends goods to outside India, they have to declare it officially. This is done through something called EDF form, export declaration form. You give this form in duplicate to the custom commissioner. Custom will check and approve it. Then the original copy goes to the nearest RBI office and the duplicate come back to you so that you can give it to your authorized dealer bank, basically your AD bank. So duplicate copy is there, custom copy send one copy to the RBI and one copy is returning back to you. Now, if you are exporting software, audio, video, TV content, you won't use EDF. Instead, you will use soft-text form. This form is given in triplicate, meaning 3 copy, to a designated officer at a place like STPI, FTZ or SEZ. All 3 copy are stamped and signed, and then the original goes to RBI. 1 copy come back to you, and 1 stays with the officer. Once you receive the payment from your foreign buyer, your ready bank will keep those duplicate EDF or Softex form for their record, right? And here is the important deadline. Normally, export payment must be received and brought back to India within 9 months from the date of export, whether you are SEZ, EOU, STP, ESTP or BTP. But you have sent good to an overseas warehouse, you get a little more time, which is a 15 months from the shipment. So in short, fill the right form, submit it to the right place, and make sure your payment come in time. These are the very important thing. So we have discussed in detail in our course. In our course, you will get unit-wise videos, explanation of each and every content in the lucid manner, so that you have conceptual clarity, right? You can get all this in our course. You can check the course in the description section. Now let's talk about the submission of the export document. So I told you that timeline I think we have discussed. So whenever you export good or even software and media, you have to declare it officially using EDF or Softex form. Timeline I told you, once you have exported the goods, there is a 21-day timeline, so that you can submit this document to your bank, but not just any bank. It has to be the authorized dealer bank, right? So you remember, for software and media export, the 21 days are counted from the date your Softex form is certified. Think of it as this: you ship your good, clock start ticking, 21 days to submit paper to your bank, right? Then we have the something called ODI. What is ODI? ODI is the overseas direct investment. Yes. So before that, let's talk about ACU country. So basically what is ACU? That trade with Sri Lanka from 8 July 2022. All eligible current account transactions, including trade with Sri Lanka, can be settled in any permitted currency outside the ACU framework under further notice, right? So remember, these are the guidelines. Now let's talk about the ODI. So ever heard of the Indian company going global? That is called outward direct investment, and it is exactly how Indian brands set foot in the international market. So outward direct investment, or ODI, simply means when Indian company invest money in another country to start or expand its business there. You can think of it like this: if an Indian company open a factory, office, or buy a big share in the company abroad, that is called ODI. Or we can call it outward foreign direct investment or direct investment abroad. How it is different from FDI? FDI is a foreign company comes and invest in India. ODI is an Indian company goes and invest abroad. So usually ODI happen in two ways. The first way is called wholly owned subsidiary, right? The Indian company fully own the overseas business, that is called wholly owned subsidiary. Second case is the joint venture, which means Indian company partner with a foreign company to run the business together. So ODI happen in two ways: WOS or joint venture. Why do companies do this ODI? Because to expand their brand and to grab new customer in the other country, right? So how they can invest? They can invest through automatic route or through approval route. Automatic route means no government or RBI approval is needed if it follow the state rule. And approval route means a special permission is needed when it does not fit in the automatic route norms. Now ODI means Indian money plus foreign business. It help company grow global, right? So WOS is one way through which ODI happen, or joint venture is another way. Now let's talk about the offshore investment, offshore investing. So that basically what is the meaning of offshore investing? Let's discuss this point. So overseas investment by Indian citizens are governed by the Indian Foreign Exchange Control Regulation. So basically it enables global diversification, access to the international market, leading business. Let's talk something about FDI, FTP. So FDI basically means when someone from one country invests their money into a business in another country. But the FDI can happen in different way. Foreign direct investment, equity capital, right? So you can do the FDI. You can classify the FDI by the nature of the investment. Either it can be equity capital, which means this is the simplest way. You directly buy the share, right? You directly buy the share in a company abroad, just like buying share in India, but here you are buying in a foreign company. That is called equity capital. Second is the reinvested earning. What is the meaning of reinvested earning? Which means that suppose you already have a business in another country and it make profit. So instead of bringing the profit back home, you put it back into the foreign business to help it grow. And finally, we have intra-company loan. So what is the meaning of intra-company loan? This is like lending or borrowing money between a parent company and its branch in the other country. What are the types of FDI? I told you vertical FDI, horizontal FDI, conglomerate FDI, platform FDI. These are the different types of FDI. So here you can see types of FDI by nature. I told you. What is the meaning of horizontal FDI? Means you start the same type of business in another country. For example, an Indian clothing brand opening a store in the US. What is vertical FDI? Here you invest in different stages of your supply chain abroad. like a car company from India setting up a tire manufacturing unit in the Thailand. Means you invest in a different stages of your supply chain abroad. Different stages of your supply chain, right? So you are setting a tire manufacturing unit in Thailand, right? Then we have conglomerate FDI. So you invest in a totally unrelated business. For example, Indian IT company buying a food processing factory in Europe. And finally, we have the platform FDI, which means you set up operation in one country, but the goods and services are made mainly to export to a third country. Mainly company do this in low cost or free trade zone. Finally, if you look at the routes for FDI into India, it is automatic route, which means easy entry, no prior permission needed from RBI or the government. Government route, which means you must get approval first through the foreign investment facilitation portal. Then we have something automatic plus government route. In some cases, part of the investment is automatic, but certain approval are still required. So in short, FDI can be of different types depending on how you invest, what business you invest in, and which route can you take to enter a country. Now, basically if we compare FDI and FII, so let's clear the confusion between FDI, FII and FPI. These three terms that sound similar but mean very different. You can think of FDI like planting a tree in someone else's garden, but you also take care of it. Here an investor from one country put money directly into a specific business in another country. They usually take a controlling a stake, bringing technology, research, skill, even business strategy. For example, a global car company setting up its own manufacturing plant in India. That is FDI. FII is different. Here the big institution like a mutual fund or pension fund invest in the financial market of another country. They don't run the business, they just buy share or bonds and hope that value goes up. And it is money only, no control. While in FDI there is a controlling stake. While FPI is called foreign portfolio investment, what happened here is like FII cousin. It is when investor, foreign individual, fund or institution, they buy financial asset like a stock, bond, mutual fund or even fixed deposit in another country. But again, this is a kind of passive investment. So if we see the categories of FPI, right? So there you can see there the first category is government. Basically, as per SEBI, there are three categories of FPI. Category 1 is government, central bank and big international bodies. Category 2 is regulated institution like mutual fund, insurance company, bank, portfolio manager, etc. And category 3 is other like NGO, trust, foundation and even individual. Now who regulate this? In India, SEBI is the main regulator under the Foreign Portfolio Investor Regulation 2019. FPI must also follow FEMA and the Income Tax Act. So you suppose you if you are an entity that is not regulated, you can still register as category number 3 FPI, but you don't apply directly to the SEBI. You go through the DDP. What is DDP? Designated Depository Participant. So what I'm talking about, suppose you are an entity that is not regulated, so you can still enter FPI, category 3 FPI, but you don't apply directly to the SEBI, you go through DDP. So in short, we can say FDI is a long-term controlling investment. FII or FPI, they are short-term market focus, no control, right? Now, some more points about FPI given in your syllabus. Let me discuss that also. So let's break down some important rule about the FPI. Any single foreign portfolio investor cannot hold more than 10% of the company total share. This keep control in local hand and avoid one foreign investor taking over. An FPI can have only one depository account for all of its investment. Think of it like a single locker for all your share. FPI can place order directly with the broker. No middleman is required. Right. Eligible investor include NRI and overseas organization. So remember, FDI is just like hands-on investment in a business with ownership and control. And FII is the money puts into financial market but no operational control. Now friends, about the foreign companies setting up in India, there are three main types of offices they can open: branch office, license office and project office. What is branch office? Branch office is opened to carry out business activity like manufacturing or services. License office is opened which is like a communication bridge but no actual business transaction. And project office is set up for a specific project in India. RBI approval is needed before a foreign entity can open a BO, LO or PO, right? So remember, approval is required. Then BO in SEZ. Foreign company can open branch office in a special economic zone for manufacturing or services under certain condition. What is the bank account for BO? For credit means money in, fund from the head office and legitimate operational earning. What about the debit, which means money out, local expense, profit repatriation, closing down payment? What about the bank account for PO? Most foreign company can open one without prior RBI approval if they have a government or PSU awarded project. right? Suppose what I'm talking about, most foreign company can open one PO. So basically, you know, this BO, PO, LO, these are the different type of offices that foreign company can set up in India. Branch office, license office, project office, right? So bank account for BO, it can be for credit, means money coming in, debit, money going out. Now if we talk about the bank account for PO, most foreign company can open one project office account without prior RBI approval if they have given a if they have a government or PSU awarded project. There are some rules for BO, PO and LO. Let's have a look on it. You know that if we talk about the project office, bank can open foreign currency account for them, usually in dollar or one in the currency of the company home country. These account don't earn interest. They must be closed when the project is completed. If we talk about the license office, you know, bank can extend their validity for up to 3 years at a time. But for construction company, real estate developer, NBFC, the limit is just 2 years.